some similarities in the tax treatment of group life insurance and individual life insurance, there are also some notable differences. Group life insurance basics. Group life insurance is provided through a group insurance master policy owned by the group plan sponsor, for example, employer, labor union, etc. The amount of life insurance coverage provided for each employee is typically a percentage of his or her salary, such as 100%, 150%, 200%, etc. As with individual life insurance, death benefits paid to the employee's beneficiary under a group life plan are exempt from income taxes, though interest earned on funds retained by the insurer under a settlement option is taxable in the year earned. Taxable employee benefit. As an employee benefit, employer-funded group life coverage may be taxable to covered participants. Per Section 79 of the Internal Revenue Code, the value of employer-paid group term life insurance up to $50,000 is a tax-free benefit to the employee. The value of coverage in excess of $50,000 is a taxable benefit to the plan participant, who must include the amount in his or her income for tax purposes. For tax purposes, the value of employer-paid group term life insurance in excess of $50,000 is determined under IRS Table 1, below, which lists the monthly cost per $1,000 of group life coverage by age. These values, not the actual premium costs the employer pays, are used in determining the taxable value of the employer-funded group life coverage. Because it is reported as income on plan participants' Form W-2, this taxable value is called imputed income. Please pause the audio and review the table. Employee contributions offset imputed income. Employee contributions are not tax deductible, though they can help reduce the tax impact of employer contributions. An employee's after-tax contributions are subtracted from imputed income on a dollar-for-dollar basis, thus reducing the tax liability. Note that this applies only to after-tax premium contributions, i.e., contributions deducted from the employee's net take-home pay. Employee contributions paid using pre-tax contributions, for example, as part of a cafeteria plan, cannot be used to offset imputed income. Example: after-tax employee contributions to a group life insurance plan directly reduce the imputed income of the plan sponsor's contributions, thus reducing the tax hit. Consider the 53-year-old employee who has $175,000 in employer-sponsored group life coverage. The IRS Table 1 monthly cost for this employee is 23 cents per $1,000 of coverage in excess of $50,000, i.e., $125,000. The taxable imputed income for the year is $345, i.e., 23 cents times 12 months, times 125. If this were a non-contributory plan, the employee's year-end W-2 would report $345 as income. In this case, it is a contributory plan into which the employee contributes $25 per month, $300 annually. This amount is deducted from the imputed income, leaving a net amount of $45 reported on her W-2. Employer deduction. Although employees cannot deduct their group life insurance contributions, the employer can deduct its premiums as long as the plan does not discriminate against rank-and-file employees. To ensure that this does not happen, the plan must meet one of the following two requirements. At least 70% of all employees must participate. At least 85% of the plan participants must be rank-and-file employees. For your review, the value of employer-paid group term life insurance up to $50,000 is a tax-free benefit to the employee. The value of coverage in excess of the first $50,000 is treated as a taxable benefit to the covered employee, reported as imputed income. Though employee contributions are not tax-deductible, contributions the employee makes toward the cost of his or her group life coverage is subtracted from the imputed income on a dollar-for-dollar basis. While employee-paid group life premiums are not deductible by employees, the employer can deduct premiums it pays on a group life insurance plan as long as the plan is non-discriminatory.
Okay, so this one's going to be kind of short and sweet. Here's our 4 questions. What part of the employee funded group life insurance coverage, if any, is tax exempt? I'm going to say 0 or the full amount. I don't know which. Which of the following statement best describes the employee paid premiums for a non-discriminatory group life insurance plan that are treated for tax purposes? Employees may only deduct paid for key employees in a group life insurance plan. Group life insurance premiums are not taxable. Employees may only deduct premiums paid for rank and file participants. Employees can deduct premiums paid on a group life insurance. Alright, I'm not too sure on that one, so we'll just go with what we have. Alright, let's go with this. Which statement correctly describes the income tax treatment of employer-funded group and life insurance coverage? As long as the plan is non-discriminatory, 100% of employer-paid group and life insurance is tax-free. The value of the first $50,000 is tax-free. The value of the coverage exceeding $50,000 is taxable. The value of the coverage exceeding the gross income is taxable to the employee. Below that is tax-free. I have no idea, so I'm going to go with the first one. All right, Thomas, 45-year-old senior account under ABC's employer payroll group. Tom's coverage is $120,000. What amount of that coverage is taxable? It's either 120 or 0. What do you think? 0? Let's put 0 and see what happens. All right. And we got none of them correct. Oh, we did some bad guessing on this one. All right. The answer to the first one is the value of the first $50,000 of coverage is tax exempt. After that, it is taxable. All right. 2. Employees may deduct premiums paid for all participants in group life insurance plan. They can deduct their premiums paid on group and life insurance plan. All right, number 3. The value of the first $50,000 of an employee-paid group and life insurance is tax-free. Coverage exceeding $50,000 is taxable. So apparently they got the same question in here twice, which they may do that thing on the test. They may put almost the same question in there twice and word it a little differently. Because this is just like the one up above. It's just worded a little differently. The value of the first $50,000 of coverage is tax-free. All right, did we get the last one right? No, the answer is $70,000. Okay, the cost of the first $50,000 is tax exempt. Okay, so it would be 120 minus 50. I knew there was going to be some kind of catch to that. 120 minus the first 50, so he only pays tax on the 70,000. All right, that's it on this lesson. I'll see you all in the next one. Be sure to subscribe, like, and share. Thanks, everybody.